Well, it's all about something called the yield curve. For your viewers, I'm sure they're probably somewhat familiar with this, but we look at the treasuries and you've got the 1 month treasury and that goes all the way out to a 30-year treasury. So this is what we would call the treasury curve. And what we have seen historically is when it inverts, so what that means is the long-term interest rates are actually lower than short-term interest rates, which is the opposite of what they should be. Because if I'm going to lend you $1,000 for 2 weeks,
Sure.
I'm going to charge you a much lower interest rate.
I might even do it for free.
Right. And let's compare that to if I'm lending you that $1,000 for 30 years. Well, now all of a sudden I got a ton of risk. I've got inflation risk, I've got counterparty risk, and therefore I'm going to charge you a much higher interest rate. So that's why you almost always see longer term interest rates much higher, right? It's just like if you go to the bank and you have an adjustable rate mortgage, okay, that's going to be a lower interest rate than if you have a fixed rate mortgage over 30 years. It's the exact same concept.